Io 2026 premium $2.105 per month. Previous auto $137 SIP. The numbers didn't make sense at first. Chris O'Donnell read the email twice, then three times, the cursor blinking on his laptop screen like a pulse. His wife looked over his shoulder from the kitchen doorway, dish towel still in hand, and the silence between them stretched long enough to ache. This wasn't a billing error. This wasn't a glitch in the system. This was the price they'd pay to stay alive in 2026. A jump of $1,300 every 30 days. Money that didn't exist in their budget. Money they'd been saving for a retirement that now seemed like a cruel joke. Chris was 58. He'd started a freelance consulting business after the layoff in July, the kind of pivot people his age made when corporate restructuring decided they were too expensive to keep. His wife had diabetes. She was a cancer survivor. Not having insurance wasn't a choice. It was a death sentence delivered in installments. But paying this premium meant draining everything they'd built, zeroing out the modest 401k they'd nursed through 2 recessions, and hoping nothing else went wrong. And the question burning in both their minds, the one neither wanted to say out loud: what happens when you do everything right, and the system still abandons you? Across the country, millions of families were opening similar emails, logging into similar portals, staring at numbers that felt like sentences. Amy Jackson in Missouri saw her monthly premium leap from $275 to $1,250. She worked in medical billing, which meant she understood exactly how broken the machinery was, how insurance companies calculated risk and passed costs downstream, how the people who needed coverage most were the ones being priced out. She'd just been diagnosed with breast cancer in October. The timing felt cosmically unfair, rushed through as much treatment as possible before the year ended, before the new rates kicked in, before the safety net disintegrated. Robert Bixon in Florida, 61 and retired, faced premiums of $4,500 a month to cover himself, his wife, and one son. $4,500. The number was so absurd it almost didn't register as real. These weren't outliers. These were the new baselines, the cost of survival in a country that had decided healthcare was a commodity, not a right. The technical explanation was straightforward enough. Premiums for Affordable Care Act marketplace plans were rising by an average of 26% in 2026. In states using the federal exchange, the benchmark premium was jumping 30%. But those percentages obscured the real violence of what was happening. The enhanced premium tax credits, the subsidies that had kept coverage affordable for 22 million Americans, were set to expire on December 31st. Congress had extended them twice before, temporary patches on a system everyone knew was unsustainable, but now the political will had evaporated. The government shutdown had consumed all the oxygen in Washington, 43 days of paralysis that ended only when Democrats gave up their demand to include subsidy extensions in the funding bill. Republicans had refused to negotiate. The stalemate became a siege, and when it finally broke, the healthcare issue was left behind, unresolved, a time bomb set to detonate in living rooms across America. Insurers had seen this coming. In rate filings submitted throughout the summer, company after company cited the subsidy expiration as a driver of premium increases. The logic was cold and actuarial. If subsidies disappeared, healthier people would drop coverage, leaving behind a sicker, more expensive pool of customers. To compensate, insurers raised rates preemptively, building in a cushion for the adverse selection they knew was coming. It was a self-fulfilling prophecy. Raise prices because you expect people to leave, and then watch people leave because you raise prices. One Maryland insurer applied a 4.4% adjustment specifically to account for the decline in enrollment due to higher post-subsidy premiums, predicting that healthier members are expected to leave at a disproportionately higher rate. Another cited rapidly increasing utilization of GLP-1 medications like Ozempic, drugs that had become cultural phenomena even as their costs ballooned. Hospital prices were climbing at 7 to 8% annually, drug costs the same. All of it compounded, all of it passed on, all of it landing on families who believed the promise that healthcare would be within reach if they just worked hard enough. The politics of it felt especially cruel. Democrats had fought to extend the subsidies during the shutdown negotiations, arguing that letting them lapse would be catastrophic for middle-class families. Republicans had dismissed the concern as partisan theatrics, framing the enhanced credits as an unsustainable expansion of government dependency. The cost of extending them for another decade was pegged at $350 billion, a figure that Republicans said the country couldn't afford even as they pushed for tax cuts that would cost far more. The impasse wasn't really about money, it was about philosophy, about whether healthcare was a public good or a private transaction, about who deserved help and who was expected to fend for themselves. And while the debate raged in conference rooms and on cable news, real people were making brutal calculations: skip the insurance and gamble on staying healthy, downgrade to a bronze plan with a deductible over $7,000, redirect retirement savings into monthly premiums, take on debt, ask family for loans, or simply go without and hope for the best. What made the crisis especially insidious was how it targeted the middle. If you were poor enough, you still qualified for Medicaid in states that had expanded it, or for subsidies even without the enhancements. If you were rich enough, the premium hikes were annoying but manageable. But if you were in that middle band making 50, 60, 70,000 a year, maybe a bit more, you were in the kill zone. You earned too much to get meaningful help, but not enough to absorb a doubling of your healthcare costs without tearing apart your financial life. You were the family that had scraped together a down payment on a modest house, the couple that had finally started saving for their kids' college, the freelancer who'd taken the leap into self-employment. You'd done what you were supposed to do. You'd worked, saved, planned, and now the system was telling you that none of that mattered, that you were on your own, that the safety net you'd been counting on was actually a temporary promotional offer that had expired. The open enrollment period had started on November 1st, which meant families had roughly 6 weeks to make a decision that would define their financial and physical health for the next year. Some states were trying to soften the blow with their own subsidies, but most didn't have the budget or political will. The federal government, paralyzed by partisan gridlock, offered no reassurance. Officials at the Centers for Medicare and Medicaid Services released upbeat statements about marketplace stability and consumer choice, carefully avoiding any mention of the premium increases. It was a masterclass in bureaucratic denial, the kind of messaging that made people feel gaslit. Don't worry about the numbers on your screen. Don't trust your own eyes. Everything is fine. But everything wasn't fine. Art Kaplan, a medical ethicist at NYU, pointed out that many ACA enrollees were people who worked for small businesses that didn't offer health benefits, or who were self-employed, or who'd been laid off and were bridging the gap between jobs. These weren't people gaming the system. These were the backbone of the economy, doing essential work without the safety net that came with corporate employment. And now they were being asked to choose between financial ruin and the kind of vulnerability that kept you awake at 3 in the morning, wondering what would happen if you got sick, if your kid got hurt, if the chest pain turned out to be something serious. The insurance industry, predictably, blamed everyone but themselves. Premiums were rising because healthcare costs were rising. Drug companies charged too much. Hospitals inflated their prices. Patients overused services. The logic was circular and self-serving, a way of deflecting responsibility while extracting maximum profit. No one wanted to acknowledge the fundamental dysfunction at the core of the system, that tying healthcare to employment was cruel and inefficient, that allowing private insurers to function as gatekeepers created perverse incentives, that treating medicine as a market inevitably meant some people would be priced out of survival. The ACA had been a compromise, an attempt to expand coverage without dismantling the existing framework, and its fragility was now on full display. Without the subsidies, the whole structure wobbled. With them, it was at least functional for millions. The difference was $350 billion over 10 years, less than 0.5% of GDP, a rounding error in the federal budget, but it might as well have been $1 trillion for all the political will that existed to spend it. Virginia, Chris O'Donnell was doing the math over and over, hoping the numbers would somehow change. $1,300 a month, $15,600 a year. That was more than they spent on groceries and utilities combined. That was a used car every year, a down payment on a rental property, the cost of sending a kid to state school for a semester. It was real money, life-changing money, and it was vanishing into a system that would still hit them with co-pays and deductibles and out-of-network surprises. His wife needed quarterly checkups, blood work, insulin. The cancer was in remission, but remission required vigilance, scans and consultations, and the kind of ongoing care that only felt routine if you could afford it. Going without insurance meant betting that nothing would go wrong, and their history said that was a bet they'd lose. Amy Jackson in Missouri was running a similar calculation. Her current premium was affordable at $275 a month, low enough that it didn't force impossible trade-offs, but $1,250 was half her monthly income, an amount that would consume her housing budget, her food budget, the modest cushion she'd built for emergencies, and she had an emergency breast cancer diagnosed just weeks ago, treatment that needed to continue into the new year. She was rushing to get as much done as possible before December 31st, front-loading appointments and scans and procedures, trying to cram a year's worth of care into 2 months. It was a kind of medical triage driven entirely by economics, and it made her furious. She worked in healthcare. She billed insurance claims for a living. She knew how much money flowed through the system, how much was skimmed off by administrators and middlemen and investors, and yet here she was, a 56-year-old woman with cancer trying to figure out how to afford staying alive. Robert Bixton's situation was even more surreal. $4,500 a month for a family of three, $54,000 a year. That was more than many people's entire salary, more than a mortgage in most parts of the country, more than seemed possible to spend on something as abstract as insurance. But it wasn't abstract. His wife had health issues, his son needed coverage, and at 61, Bixson was too young for Medicare, but too old to gamble on going uninsured. The retirement he had planned, modest travel, time with grandkids, maybe a part-time hobby turned into a small business, was evaporating. Instead, he'd be working to pay premiums, funneling his savings into an insurance company's quarterly earnings report, hoping he lived long enough to make it to 65 when Medicare would finally kick in. The stories multiplied across the country. Christine Widener, facing premiums that would force her to choose between insurance and credit card debt that would destroy the credit score she'd spent years rebuilding. Ezra McKay, a teacher who supplemented his income with freelance work, watching his affordable plan disappear into unaffordable territory. Again about right, self-employed, and suddenly priced out of the market entirely, left to navigate a healthcare system designed for people with employer-sponsored plans. Each story was different in its details, but identical in its core. Ordinary people, working people, people who'd followed the rules, now being told that the rules had changed and they were on their own. The deadline added a layer of psychological torture. December 15th was the cutoff for coverage that would start January 1st. If you missed it, you'd be uninsured for months, vulnerable to the kind of catastrophic costs that could bankrupt you instantly. But signing up meant committing to premiums you might not be able to afford, locking yourself into a year of financial strain. And there was always the chance, remote but real, that Congress would do something at the last minute, extend the subsidies in some last gasp compromise, render all the agonizing moot. But betting on Congress to function was its own kind of gamble, one that recent history suggested was foolish. What kept people up at night wasn't just the money, it was the sense that the social contract had been shredded. You were supposed to be able to work your way into stability, into security. You were supposed to be able to plan, to save, to build something that would carry you through the inevitable hard times. But healthcare costs were growing faster than wages, faster than inflation, faster than any reasonable ability to keep pace, and the subsidies that had made the math work, that had bridged the gap between what insurance cost and what people could pay, were being yanked away in the name of fiscal responsibility by lawmakers who'd never had to worry about a surprise medical bill in their lives. The insurance death spiral was already beginning. Younger, healthier people were doing the math and deciding to risk going uninsured. Why pay $1,200 a month for coverage you might not use? Why not just save that money, gamble on staying healthy, and deal with the consequences if something went wrong? It was a rational calculation on an individual level, but collectively it poisoned the risk pool. Every healthy person who dropped out made premiums higher for those who remained, which drove more people out, which raised premiums further. Insurers knew this. Actuaries had modeled it, and their response was to raise rates preemptively, protecting their profit margins while accelerating the very exodus they feared. Some policy experts were calling for a return to catastrophic coverage, stripped down plans that would cover major emergencies, but leave routine care to out-of-pocket spending. The ACA had restricted these plans, mandating more comprehensive coverage, but with premiums exploding, catastrophic insurance was being reframed as pragmatic. Others argued for doubling down on subsidies, making them permanent and more generous, treating healthcare as a public utility rather than a consumer product. But those debates felt academic, theoretical, disconnected from the immediate crisis of families opening bills they couldn't pay. Chris O'Donnell finally made his decision. He'd keep the insurance. He'd zero out his retirement contributions, redirect every spare dollar into premiums, and hope that his freelance business picked up enough to make it work. His wife couldn't go without coverage. The risk was too high, the stakes too clear. So they'd pay, they'd sacrifice, they'd do what they had to do. But the bitterness was corrosive, the sense that they were being punished for needing health care, that the system was designed to extract maximum revenue from their vulnerability. And he wondered how many other families were making the same choice, how many were choosing differently, how many would end up uninsured and one accident away from catastrophe. Amy Jackson made a different call. She'd keep the insurance through the cancer treatment, whatever it cost, even if it meant credit card debt and destroyed savings. But after that, if she was in remission, if the prognosis was stable, she'd reassess. Maybe she'd drop down to catastrophic coverage. Maybe she'd take the gamble. The thought made her sick, but so did the idea of paying half her income for insurance indefinitely. She'd spent her whole adult life being responsible, making prudent choices, and it felt like none of that mattered anymore. The system didn't reward responsibility. It punished need. Robert Bixson contacted a broker looking for any alternative that might be cheaper, maybe a faith-based health sharing ministry, maybe a short-term plan that skirted ACA regulations, maybe anything that didn't cost $54,000 a year. The broker was sympathetic but realistic. Most alternatives were either scams or so limited in coverage they weren't worth the premium. Bixson was caught between unaffordable insurance and the unthinkable risk of going without. So he'd pay. He'd sell some investments, cash out part of his retirement, and pay. What other choice did he have? In Washington, the legislative calendar rolled forward with no sign that anyone was prioritizing a subsidy extension. There were too many other crises, too many competing demands, too little appetite for the kind of bipartisan compromise that would be required. Some Democrats floated standalone bills to extend the credits, but they died in committee, blocked by Republicans who saw them as fiscally irresponsible expansions of government. Some Republicans suggested means testing the subsidies more aggressively, cutting eligibility to free up money for other priorities. The proposals went nowhere. The status quo, subsidies expiring, premiums exploding, millions losing coverage, was the path of least resistance, the outcome that required no one to make a hard vote or spend political capital. The human toll was predictable, but no less brutal for being expected. An estimated 4.2 million people would lose coverage over the next decade if the subsidies expired, pushed out by premiums they couldn't afford. Emergency rooms would see an uptick in uninsured patients, people delaying care until minor problems became major crises. Medical bankruptcies would rise, preventive care would decline, chronic conditions would go unmanaged. And the cost of all that, the cost of emergency care, of uncompensated treatment, of lost productivity and shortened lifespans, would dwarf the $350 billion it would have cost to just extend the subsidies. But those costs were diffuse, hard to measure, easy to ignore. The subsidy extension had a price tag. The human suffering didn't show up in the Congressional Budget Office's scoring. The cruelty of it all was that this was a choice. It wasn't an act of God, wasn't an inevitable consequence of economic laws or natural scarcity. It was a political decision made by people who had the power to decide differently and chose not to. The subsidies could be extended tomorrow if the will existed. The premiums could be stabilized if Congress acted, but action required compromise, required both parties to prioritize the well-being of millions of people over scoring political points, and that kind of leadership felt like a relic from another era. Chris O'Donnell went back to his laptop, enrolled in the same plan he'd had in 2025, and confirmed the payment method. The first premium of $21.55 would hit his bank account in January. He'd figure out how to make it work. He always did, but the anger sat heavy in his chest, the sense that he was being robbed in slow motion, that the country he'd believed in, the one that at least pretended to care whether working people could afford to see a doctor, was a fiction he'd been naive enough to trust. His wife came back into the room, asked if he'd finished, and he nodded. She didn't ask how much. She didn't need to. They both knew what this year would cost, what they'd give up to stay insured, and what that said about the value their government placed on their lives. Outside, the sun was setting over Richmond, the same sky that stretched over Missouri and Florida and every other place where families were making the same impossible math work. The emails had been sent, the premiums had been set, the deadline was approaching, and somewhere in Washington, lawmakers who'd never missed a paycheck, who'd never had to choose between insulin and rent, were moving on to the next crisis, confident that this one would fade from the headlines soon enough. They were probably right. Crises that unfold slowly, that happen in kitchens and living rooms, instead of on camera, rarely held the public's attention, but they were no less real for being quiet, and the people living through them would remember.